An extraordinary confrontation is unfolding between the U.S. government and the Federal Reserve, and markets are watching closely. In early January, the Justice Department quietly issued grand jury subpoenas to the Federal Reserve, demanding documents related to a multi-billion-dollar renovation of its Washington buildings. Days later, the Fed's chair publicly confirmed the subpoenas and warned that they carry the threat of criminal charges tied to his prior testimony to Congress. The Fed's response was blunt. The chair said the investigation is not really about buildings at all. He described the allegations as a pretext, arguing the real issue is pressure on the central bank over interest rates. At the center of the dispute is a long-running renovation of two historic Fed buildings in Washington, D.C. The project has grown roughly $600 to $700 million over its original budget, largely because of higher construction costs, historic preservation requirements, and the removal of asbestos and lead. The Fed says the work focuses on safety and infrastructure, plumbing, electrical systems, elevators, accessibility, and fire protection. Claims that the renovation included luxury features such as VIP dining rooms, private elevators, rooftop gardens, or beehives have been repeatedly denied by the Fed and contradicted by its own disclosures. According to the Fed, those elements appeared only in outdated early plans and were never built. Despite that, the renovation became a political flashpoint. For months, the White House has attacked the Fed over interest rates, arguing that borrowing costs should be lower. The president has publicly criticized the pace of rate cuts, questioned the Fed chair's judgment, and suggested removal would be possible if fraud were proven. The renovation probe now sits directly in that context. The Fed chair says the subpoenas represent an unprecedented escalation. In a recorded statement, he said the central bank has cooperated fully with Congress, respects the rule of law, and will comply with legal requests, but warned that using criminal investigations to influence monetary policy crosses a dangerous line. Lawmakers and economists echoed that concern. Several senators warned that politicizing criminal investigations threatens the credibility of both the Justice Department and the central bank. Economic historians pointed out that Congress deliberately designed the Fed to operate independently, insulated from short-term political pressure. Markets reacted quickly. After the Fed chair's statement, U.S. stock futures slipped, the dollar weakened, and gold jumped on safe haven demand. Analysts warned that if investors begin to believe monetary policies being politicized, confidence in U.S. assets, including treasuries, could erode. The economic stakes are significant. Central bank independence is widely viewed as critical to controlling inflation and anchoring expectations. History shows that when political pressure dominates monetary policy, inflation risks rise and financial stability suffers. For now, the subpoenas are part of an evidence-gathering process, not proof of wrongdoing, but the broader issue is already clear. This is no longer just a legal dispute over construction costs. It is a test of whether U.S. monetary policy will continue to be set by economic data or by political pressure.